Hello everyone, welcome once again. In this video we'll explain you the concept of strangling, one example, one advantage and disadvantage. But before getting into details, let us start our lesson with one of the famous quote. You get a recession, you get a stock script declines. If you don't understand that's going to happen, then you are not ready and you will not do well in the market. This quote was from Peter Lynch. Let us understand how selling option strangle works. The short option strangle is basically a variant of selling naked puts and calls. As a topic of fact, it is selling naked puts and calls. It is just doing both at the same time. Short strangles or simple strangle, as we refer to it, is the strategy of selling a naked out of the money call and a naked out of the money put on the same script. The strangle is most effective when the price of the underlying script remains in a defined range. Let us understand a strategy through an example. Based on the HDFC bank price graph, let's create a short strangle. On 3rd August, HDFC stock was at 1041 rupees. In order to create a short strangle, we can sell 900 OTM put September expiry at a premium of 21 rupees and would have collected 11,550 rupees. At the same time, we sold 1100 calls September expiry at a premium of 26 rupees and 50 paisa and collected 14,575 rupees. On 24 September, we quit both the position and make a profit of 26,125 rupees. A word of caution. That means does not wait till expiry of the contract. That means you need not wait till the last date of the expiry. In most of the cases, for example, during September 2020 month expiry, scrip crashed tremendously and affected even fundamentally strong stock also. Now let us understand the advantages of selling the strangle. Compensating price change. As the script sways up and down, the value of one or the other put or call will increase. Nevertheless, the value of the other option will drop, at least partially compensating for the rise in the first. Ultimately, if the spread work accurately, this harmonizing act will persist while time deterioration continues to wear down both options. This is in disparity to selling naked on one side of the script, where the trader has not offset his position. Lower margin, higher return. Because of this offsetting effect, the exchange often will strangle as a more cautious position than selling absolute naked short option on one side of the script. For this reason, the margin requirement for a strangle often will be fewer than the total of the margin that would be needed for selling one or other option by itself. The script does not have to make a large move for you to profit, unlike several of the spread in. The script does not have to make a large move for you to profit. It is basically has to remain in the profit region. In truth, it does not have to change at all. It is already in the income region. Let us understand the strangle's drawbacks. Though the strangle is an outstanding option writing approach to use in many circumstances like any other methods, it has shortcomings also. It is susceptible to a large movement in the script, while the option sold on the other side of a strangle will compensate loss of an undesirable move against the other. This compensating effect is restricted. If a trader is simply selling naked puts, a huge chance to the upside will significantly help the position. A break move in one trend can cause a defeat on one of the options that outdo the gain to the other. A strangle still has infinite risk on the positive or the downside and consequently must be handled like a naked option position. Another drawback, it has a limited profit zone. The income area for selling naked option on one side of the script is limitless. The profit zone for a strangle, no matter how broad it is still limited. The price must stay on a certain scale. Let us understand how to manage risk in selling the strangle. Managing risk on a strangle sometimes can be easier than managing risk on a naked position on one side of the script. A common risk management technique for option seller is the 200% rule. The 200% rule states that you buy an option back if it doubles in value. It is a great rule, especially for beginner because of its simplicity. If you use the 200% rule on a strangle, then if the put and the call were sold at approximately the same premium, you could exit either the put or the call when it is doubled in value. The odds of the scrip making a complete reversal and moving far enough to cause the other option to double would be unlikely, although not impossible. Therefore, if the 200% rule is used in a strangle position, there is a good chance that one could come close to breaking even when losing on one side of the trade. We'll look into next strategy in the next video. Thank you once again and happy learning.